board, Krishna Kumar of Sundaram Mutual Fund to take conversation forward. KK, fantastic to have you back. First, you were making a case for mid and small cap stocks for them to come back. Then you started thumping the table, and then you started making a case for mid and small cap stocks. Then you started screaming and say, look, small and mid cap stocks have to make a comeback. Now I think everybody in the market is reaching that stage where you start banging your head against the wall, and yet markets ignoring for a call on mid and small cap stocks.
I think, Nikunj, clearly we've been constructive about the markets at large, and what we've been maintaining is that as you see improvement into this third quarter and fourth quarter of the year, you would see the markets get broader in terms of rally, and of course that would percolate into the mid and small caps. The reality is that in the last 3 years, the large cap indices are up about 50 to 60%, whereas the mid and small cap indices are probably just about 10 to 15% up or lower. And current year, I think you again had a similar underperformance continuing also. So I think valuations being reasonable, I think there is a case. Of course, the economy, growth has been stuttering, and we have seen that the data that the market currently is looking at is most of the second quarter numbers, and you are, probably seeing that the improvement that expected in the third quarter is not as sharp as one expected to be. Having said that, I think there is a lot of improvement on the inventory destocking at the channel level across various products, including consumers. So we do believe that the factory orders, the manufacturing engine is starting to do better at this point in time. You would definitely have seen the Maruti YOY manufacturing get better after about a year's time. So also the case of a lot of other auto ancillaries, we do hear at the ground level that the schedules are getting better. So we stick to our conviction that there will be improvement into the next 3-4 months, and we would see that being invested in the broader market at this point in time would give you far better returns. Of course, one cannot look at equities from a 3 months perspective, 6 months perspective. There will be some positives or disappointments that could come through, which is unexpected. But I think all of us are in the game for long term, isn't it?
But all of us thought that economy will recover closer to festival season. That's the time impact of low interest rates and corporate tax cut had to kick in. It's been 2 months and no recovery has happened. And if at all on the macro front, the picture has deteriorated, which is RBI has said inflation has come back, global markets indicating that trade war is back, and the spike in the crude will obviously dilute a lot of assumptions. So my only fear is that while it is good to have a constructive view on economy, but what was bad and what was, bad was supposed to become better. What is happening is bad is becoming ugly.
I disagree here, Nikunj, because, the extent of slowdown is definitely getting reversed. I'm sure that, the third quarter numbers are going to be around 5%. Compared to 4.5% in the second quarter. So there is a bottoming out happening as one expected. Whether the 5.5 could have been a 5.5 and then a 6 in fourth quarter, maybe, the jury is still out. You would probably be ending the year closer to 5.5% on the fourth quarter exit than a 6% that one would have expected earlier. Having said that, I think it's a little too early to kind of say that scenario is turning bad to ugly. I think the pace of improvement, of course, one could argue it's a little slower than what one expected. Having said that, I think once we are through with this BS6 transition, I think there is a larger story that could pan out on the auto hands, and that has a significant impact in terms of how the demand percolates across sectors like the metals, etc., and plastics. So I think we need to give it the next 3-4 months to see how the economy is moving. On inflation, I think as a lot of us would read, it is more on the vegetables, and that is not core inflation. Core inflation is still dropping to about 3.5% as we speak. So there is no major upthrust in core inflation. Globally, the inflation levels are low. The industries are well supplied. Crude moving up to 64, 65 is a knee-jerk reaction to the OPEC cut. In the next 1 week, we do expect it to settle down, given that the US is already one of the largest suppliers of oil, and we do expect crude curve to normalize over the next 1 week to 2 weeks. So I don't think these are all going to feed through at this point in time in terms of the inflation metric. Of course, RBI has a constraint in terms of the inflation dynamics and what it looks at, while one would on the ground believe that inflation would peak out in the next 2 months. More arithmetically on the CPI, the core inflation will continue to trend down. Also, I think people are worried a little bit about the fiscal. The bond markets are telling you that it's going to slip, and that's why the 10-year remains stubborn at 6.5% and more. So all those risks are well in the market, and people are looking at that basically. So I think with that background, we should look at it constructively in terms of medium-term outlook on equities to be there.
And I'm glad that you actually say that the economic slowdown is somewhat reversing. On the subject of autos though, KK, what is it that you're reading? Because, call it a flash in the pan, but you have had that bit of a production uptick coming in, and this is after straight 9 months of a cut or halt at the stable of Maruti. Finally, a production uptick of about 4% coming in. Do you think that the worst is behind for autos?
Yeah, I would think so that, FY21 would be a far better year for automobiles, because this year has been a year of constraints, basically. One, starting off with the liquidity issues on the NBFCs. When you had 12 guys financing you at the showroom, now we have 2-3 guys, and that's getting better to 6 guys now. So the liquidity is getting a lot better than what it was 1 year back. The second point definitely is the BS6 transition, and the increase in costs also are kind of confusing customers in terms of the benefits of BS6 versus the higher costs. So, there's been a little bit of inventory sell down that the companies have to do, because there is a hard stop on 31st of March, unlike last time around, where you can extend the sales basically into April. So the industry is working with the constraints. So the production actually that the industry is working is on a kind of a week-to-week basis, and that's making it sound like a 11-month year basically. So we do believe that the next year is going to be a normalized year, when you will have to build up a BS6 stocks well into April. So the year would start quite robustly, and the next year would definitely see a double-digit growth in autos over the year that we are into at this point in time.
Telecom, though, KK, turned out to be a spot of bother, especially in the wake of, the comments coming in from Kumar Mangalam Birla on a public platform saying that they will have to shut shop if they don't get any relief for the government. That, along with the exposure that the telecom sector per se has to banks.
Of course, every stakeholder has to make its point and try to get the maximum benefit from the other stakeholders. So in this case, again, the industry incumbents are gunning for getting more SOPs and benefits and easing moratoriums and timelines on payments. However, the government, is also quite considerate in terms of, the pressure on the industry and on the banks and, its own fiscal. So it's doing a kind of a job which is kind of balancing out all the needs of the government, the banks, and the players at large. However, it's a free economy, and the players have to learn to live with, or one has to probably kind of look to exit the business if it's not conducive, right? So I do agree, at this point in time that the incumbents are trying to get the best from the government, and the government, we believe, will take a considerate approach, and so we don't believe that the telecom issue will snowball further into any significant event. I think there will be a good resolution in terms of payouts and cash flows and matching it.
Well, Maruti is 111 rupees higher. One thing which I think autos have exhibited is that, for the moment, at least that EV fear, which was supposed to be like a real disruptive and a real fear in the short term, that's getting averted because, frankly, lack of infrastructure is going to be the biggest reason why EVs will not be rolling out the way we all thought. Okay, let me look at the bright side. and then the ugly side. The bright side is that for a lot of sectors, the base effect has kicked in. So natural economic recovery would be strong. It's not that economy is coming back, it's only the base effect will start making it look good. But the bad part is that top line has been sluggish. The bad part is that if crude spikes the way, if crude prices stay where they are, we would be importing inflation out. And C, it will have an impact on the way how interest rates would move. So which side would you focus on? Which would you magnify? Because the real recovery is not there, KK. It is the base effect which we are really betting on.
See, I think, definitely there is a base effect that will help us for the next 4 quarters. Of course, that's going to play in definitely. More importantly, I think, we should focus on the consumer in terms of the actions and on the ground, purchases and numbers would actually give you the story. I am not going to be too much concerned about the crude pricing and the imported inflation. The reason being that when there is a lot of softness in terms of the capacity in different industries, there will be some amount of absorption that happens across the value chain. Further, we also believe that, as I mentioned, we don't believe that the crude is going to stay higher for longer. So this is very transient spike that you have seen of about 5% to 6%. So I think that should get normalized over the next 1 month. Also, the most important thing that we should focus on is the liquidity. I think more banks lending into the NBFCs and the consumer segment. We are seeing that a lot of banks are putting a lot of money into the call money at this point in time. So the rebuild of confidence into the financial systems, I think, has to accelerate, and that's where the government and RBI's efforts are focused on. We also have seen that some of these schemes launched on the housing side are starting to move on the ground, with about 10,000 crores of the AF Fund 1, some action happening there. So a lot of these things would build in a lot of confidence into the financial sector, which would bring in real liquidity to the user industry. So that's what we should look at, and that would have a big effect in terms of consumer being able to leverage himself like earlier and participate in the growth.
One pocket that you do like, and we've been talking or touched upon cyclicals, but cement in particular, KK, if you could run us through the rationale there and the kind of potential that you're looking at when it comes to the cement space.
Cement is a commodity, but it's a domestic commodity. It doesn't have link to global prices on the output side. And you don't have much of imports that happens. So you're a protected industry in that sense, and more put the competition at the local level. And being a very freight-intensive industry, I think the kind of circle of operation of every company is also quite determined, given the plant locations, etc. So that makes it a lot more builds in a case for a lot of companies which are having strength in different regions to be players that we would look at. Overall, I think if you X out the South Indian companies and the capacities there, the rest of India operates at a good capacity utilization on average about 80 to 85%. And that's a very good number to have, because the rest of the 10-15% is never going to be used fully because of the operational constraints, etc., that will generally come into any operations. So it's quite a tight market. Of course, during monsoons there is weakness, but I think rest of the period, I think the industry will do well. The energy costs are definitely much under control, and that's also helping the companies to expand margins in spite of the realizations not doing as well. Further, I think we also believe that there's a lot of operational inefficiency on the supply chain, which every company is trying to address, and also able to start saving some on that front. So this is what we think, given the